Chapter 1, Part 1, Financial System. Meaning of financial system. A financial system is a system that helps move money from people who have extra money to those who need money. In an economy, some people save money while others need money to start businesses, build factories, or invest in projects. The financial system connects these two groups. The word financial means anything related to money, and a system means a group of things working together. So a financial system means a group of organizations, markets, and services that help manage and move money in the economy. It includes financial institutions, financial markets, financial instruments, and financial services. For example, when a person deposits money in a bank, that money does not simply stay there. The bank lends it to a business owner who wants to start a factory. This is the financial system at work. Features of financial system. 1. Financial institutions, organizations like banks, insurance companies, pension funds, and mutual funds that act as middlemen between savers and borrowers. 2. Financial markets, places where financial assets like shares and bonds are bought and sold. Examples: stock market, bond market, money market. 3. Financial instruments, tools like shares, bonds, debentures, and derivatives that help companies raise money and investors earn returns. 4. Financial services, services like loans, insurance, investment advice, and mutual funds that help people and businesses manage their money. 5. Regulatory framework, a set of rules and authorities like RBI, SEBI, and IRDI that supervise financial institutions and ensure fair practices. 6. Financial intermediation, the process where financial institutions collect money from savers and give it to borrowers for investment or business activities. 7. Liquidity, how easily an asset can be converted into cash. A good financial system ensures people and businesses can quickly access money when needed. 8. Price discovery, the financial system helps find the correct price of assets through demand and supply. High demand equals higher price. 9. Risk management, tools like insurance, derivatives, and hedging help protect individuals and businesses from financial losses. 10. Capital formation, savings are directed toward productive investments like industries, infrastructure, and technology. This drives economic growth. Financial services, meaning and classification. Financial services are services related to managing money, investments, and financial transactions. They help people save, borrow, invest, and protect their money from risks. Providers include banks, insurance companies, stock brokerages, mutual funds, credit card companies, and more. 2 main types. 1. Fee-based services. Banks charge a fixed fee for these services. Examples: ATM fees, account maintenance charges, money transfer charges. Fees are set based on effort, time, and risk involved. 2. Fund-based services. The institution uses its own funds to earn income. It provides loans or advances and earns interest from the borrower. Examples: business loans, home loans. Objectives of financial system. 1. To mobilize resources, collect savings from people, and make them available for useful economic activities. 2. To link savers and investors, connect people who save money with people or businesses who need funds for projects. 3. To establish smooth markets, create efficient financial markets where assets can be easily bought and sold. 4. To create assets for people, help people build financial assets like shares, bonds, and bank deposits. 5. To encourage savings and investment, motivate people to save and invest their money instead of keeping it idle, e.g. fixed deposits, mutual funds. 6. To support economic development. When businesses get money they need, they grow, expand activities, and create jobs. 7. To help financial markets grow. As more companies list shares and more people invest, markets grow and offer more options. 8. To use financial resources properly. Ensure money goes to activities where it can be most useful, e.g. loans to businesses that can expand production. 9. To help in better financial decisions, help people and businesses make decisions based on cash flow, money coming in and going out. 10. To maintain financial control, keep proper records of transactions so money is used for the correct purposes and tracked properly. Purpose of financial system. 1. Efficient allocation of resources, directs funds to sectors where they can be most useful. 2. Helps in savings and investment, encourages people to save and invest instead of keeping money idle. 3. Helps in making payments, provides safe payment methods, checks, cards, online transfers, digital payments. 4. Helps in managing risk, insurance, and other tools protect people from unexpected financial losses. 5. Helps businesses raise money, companies raise capital by selling shares in the stock market. 6. Provides liquidity, assets can be converted to cash easily when needed. 7. Supports economic stability plus encourages new businesses. Central banks use the system to control inflation. Entrepreneurs get loans to start new ventures. Functions of financial system. 1. Savings function collects savings from people and channels them to businesses and producers. Banks lend deposits to companies to produce goods and services. 2. Liquidity function allows people to sell financial assets and get cash whenever needed. Example, selling shares in the stock market. 3. Payment function enables payments through checks, debit cards, credit cards, and online transfers faster and easier than using cash. 4. Risk function helps reduce risk through diversification, spreading money across shares, bonds, and insurance instead of one investment. 5. Policy function helps government control the economy by changing interest rates. Lower rates equals more borrowing and spending. Higher rates equals less borrowing. 6. Provides financial services, insurance, pensions, investment advice, stockbroking, housing loans, equipment leasing, and venture capital. 7. Lowers cost of transactions. Organized banking systems reduce the time and cost of sending or borrowing money. Example, online banking. 8. Financial deepening and broadening. Deepening. Financial assets grow relative to GDP. Broadening. More people, companies, and products join the financial system. Components of financial system. 1. Financial institutions, banks, commercial, cooperative, rural, NBFCs, and development banks like IDBI and NABARD. They accept deposits and give loans. 2. Financial markets, money market, short-term, capital market, long-term shares and bonds, foreign exchange market, and derivatives market. 3. Financial instruments, shares, preference shares, bonds, debentures, treasury bills, and derivatives like futures and options. 4. Financial services, banking, investment advice, asset management, insurance, help people save, borrow, invest, and protect money. 5. Regulatory framework, RBI controls banks, SEBI controls stock markets, IRDAI supervises insurance, keeping the system safe, fair, and organized. Structure of Indian financial system and financial institutions. The Indian financial system has 4 main parts: financial institutions, financial markets, financial intermediaries, and financial services. All work together to move money between savers and those who need it. Financial institutions, organizations that provide financial products and services. They help people save, borrow, invest, and manage their finances. Benefits. Heavy checkmark provide financial services, middlemen between savers and borrowers. Heavy checkmark economy of scale, work with large amounts, making activities more efficient. Heavy checkmark reduce transaction cost, lower cost per activity compared to individuals. Heavy checkmark diversification, spread investments to reduce risk. Heavy checkmark financial data exchange, help share information through electronic systems. Financial markets and financial instruments. Financial market, a place where financial assets like shares, bonds, currency, and deposits are bought and sold. Price depends on demand and supply. Key characteristics: large number of daily transactions, different segments, stock, bond, primary, secondary. Arbitrage opportunities, prices can change quickly connected with global markets. Financial instruments, contracts or tools used to invest, raise, or manage money. Types. 1. Cash instruments, value depends on market, shares, deposits, loans. 2. Derivative instruments, value derived from an underlying asset like stocks, bonds or gold. Examples: futures, options. 3. Foreign exchange instruments, used in the forex market to exchange currencies for international trade. Role of financial system in economic development. 1. Capital mobilization collects savings from people and channels them into industries, infrastructure, and businesses. 2. Investment financing provides money for investment in factories, technology, and education, things that create future income. 3. Efficient use of resources sends money to projects that can produce the most goods, services, and income. 4. Encourages entrepreneurship. Easy access to finance gives people confidence to start new businesses and launch new products. 5. Encourages savings and investment. A good financial system motivates people to save in banks, shares, or mutual funds, which fuels further growth. 6. Financial inclusion brings financial services to rural and poor populations. Jan Dhan Yojana is one example. 7. Risk management. Insurance and derivatives protect farmers, businesses, and individuals from unexpected financial losses. 8. Attracts foreign investment. A strong financial system brings foreign investors into the country, helping businesses grow. 9. Infrastructure development funds large projects like roads, railways, and power plants through banks and financial markets. 10. Helps monetary policy work. Central banks use the financial system to control borrowing and spending. Example: lower interest rates equals more investment. SWOT analysis of Indian financial system. Strengths: diverse institutions, banks, NBFCs, insurance, development banks, strong regulators, RBI, SEBI, RDI technology advances, UPI, mobile banking. Fintech growing stock and bond markets, financial inclusion programs like Jan Dhan Yojana. Weaknesses: low financial literacy, high NPAs, unpaid loans in banks, large informal sector dependent on moneylenders, limited long-term funds for big projects, too many regulations slowing innovation. Opportunities: digital financial growth, rural market expansion, rise of fintech companies, green financing, solar, wind energy bonds, global financial integration. Threats: economic instability, inflation, recession, cybersecurity risks, political and policy uncertainty, global competition, climate change risks. Recent trends in financial sector. 1. Digital transformation. Banking and finance activities can now be done online. Key developments: UPI, instant money transfer via apps like GPay, PhonePe, Paytm. Fintech companies, Paytm, PhonePe, Razorpay offer digital payments, wallets, lending. Blockchain, secure, transparent digital record keeping. AI and automation, AI chatbots for customer support, fraud detection, loan risk analysis. 2. Financial inclusion, bringing banking to all people, especially rural areas. Jan Dhan Yojana, millions of bank accounts opened for the unbanked. Microfinance and NBFCs, small loans for low-income rural groups. Digital lending, fast loans based on creditworthiness using technology. 3. ESG and green finance, companies focus on environmental, social, and governance values. Green bonds fund solar, wind, and pollution control projects. 4. Hybrid banking, combination of physical branches and digital banking. Phygital, customers can use apps or visit branches. Omni-channel banking, mobile apps, ATMs, websites all stay connected. 5. Regulatory advancements, RBI Sandbox lets fintech companies test new products. Account aggregator helps share financial data securely. eKYC allows online identity verification using Aadhaar. 6. Cybersecurity, AI-based fraud detection, data protection laws, real-time monitoring to protect digital financial systems. 7. MSMEs and startups, Mudra loans, Startup India, venture capital, and digital lending platforms support small businesses and new companies. Recent trends, artificial intelligence and big data in banking. Banks are using artificial intelligence, AI, and big data to improve services and make smarter decisions. Big data means analyzing large amounts of information to find patterns and make better decisions. How banks use AI and big data. Heavy checkmark personalized services. AI analyses customer behavior and recommends suitable financial products. Heavy checkmark credit risk assessment. Data helps banks judge whether a person can repay a loan. Heavy checkmark process automation. Chatbots and virtual assistants handle routine tasks automatically. Heavy checkmark predictive analysis. Banks predict customer needs, market changes, and possible risks. Heavy checkmark fraud prevention. AI monitors transactions and detects suspicious activities to prevent fraud. Financial regulators in India. The financial system in India is controlled and supervised by different regulatory authorities. A regulator is an organization that makes rules, supervises financial institutions, and ensures the system works properly. These regulators help maintain stability, fairness, and protection for investors and customers. There are 5 major financial regulators in India, divided into 2 groups. A. Statutory bodies, created through laws passed by Parliament. Heavy checkmark Reserve Bank of India, RBI. Heavy checkmark Securities and Exchange Board of India, SEBI. Heavy checkmark Insurance Regulatory and Development Authority of India, IRDI. B. Regulators under government ministries. Heavy checkmark Forward Markets Commission, FMC. Heavy checkmark Pension Fund Regulatory and Development Authority, PFRDA. Reserve Bank of India, RBI. Meaning and establishment. The Reserve Bank of India, RBI, is the Central Bank of India, the top authority of the country's monetary system. A central bank is the main bank of a country that controls money supply, banking activities, and interest rates. Key facts. Heavy checkmark established on April 1, 1935 under the Reserve Bank of India Act, 1934. Heavy checkmark central office was first in Calcutta, then moved to Mumbai in 1937. Heavy checkmark the central office is where the governor of RBI works and important policies are decided. Heavy checkmark originally privately owned, but nationalized in 1949, meaning it became fully owned by the Government of India. The RBI performs many important functions such as controlling banks, managing currency, and maintaining financial stability in the country. SEBI and IRDI, Capital Market and Insurance Regulators. Securities and Exchange Board of India, SEBI. SEBI is the regulator of the capital market, the market where shares and bonds are bought and sold. Heavy checkmark created in 1988 as a non-statutory body, limited powers. Heavy checkmark became an autonomous body under SEBI Act, 1992 with full legal powers. Heavy checkmark main role: regulate the stock market, protect investors, and prevent fraud in share trading. Insurance Regulatory and Development Authority of India, IRDI. IRDI is the regulator of the insurance sector in India. Heavy checkmark established under the IRDA Act, 1999. Heavy checkmark headquarters in Hyderabad. Heavy checkmark protects policyholders, people who buy insurance policies. Heavy checkmark ensures insurance companies follow rules and treat customers fairly. FMC and PFRDA Commodity and Pension Regulators. Forward Markets Commission, FMC. FMC was the regulatory authority for the commodity market in India. A commodity market is where goods like gold, silver, oil, and wheat are traded. Heavy checkmark established in 1953 under the Forward Contracts Regulation Act, 1952. Heavy checkmark headquarters in Mumbai. Heavy checkmark worked under the Ministry of Consumer Affairs, Food and Public Distribution. Heavy checkmark regulated commodity trading in different exchanges across India. Pension Fund Regulatory and Development Authority, PFRDA. PFRDA is the regulator of the pension sector in India. A pension is money received regularly after retirement from work. Heavy checkmark established on August 23, 2003 by the Government of India. Heavy checkmark ensures pension funds are managed properly and safely for people after retirement. Objectives of RBI. 1. To manage the monetary and credit system, controls how much money and credit should be available in the economy so activities run smoothly. 2. To stabilize the value of the rupee, maintains the value of the Indian rupee both inside the country and in international markets. Controls inflation. 3. To ensure balanced development of banking, ensures banks grow in an organized, stable way and provides services to all sectors. Encourages rural and semi-urban branches. 4. To develop the organized money market, regulates short-term borrowing and lending activities so the money market works smoothly. 5. To support agricultural finance, helps arrange loans and financial support for farmers to buy seeds, fertilizers, and equipment. 6. To support industrial finance, ensures industries can get funds to build factories, buy machines, and expand production. 7. To manage public debt, manages government borrowing and repayment. Public debt means money borrowed by the government from the public. 8. To maintain monetary relations with other countries, works with international institutions like the IMF to participate in global financial activities. 9. To centralize cash reserves of banks, banks must keep a certain amount of their reserves with RBI. This helps RBI control the banking system. 10. To maintain balance between demand and supply of currency, ensures there is enough money in the economy, not too much, causes inflation, and not too little, slows economic activity. Organizational structure of RBI. The RBI Act states that management is handled by a central board of directors with 20 members, most appointed by the Government of India. Board members. Heavy checkmark 1 Governor, appointed by the central government. Heavy checkmark 4 Deputy Governors, appointed by the central government. Heavy checkmark 4 Directors, representing regional boards. Heavy checkmark 10 Directors, nominated by the government from different fields. Heavy checkmark 1 Government Official, nominated by the central government. The governor is the head of RBI and supervises all banking and monetary policies. For regional representations. North, New Delhi. South, Chennai. East, Kolkata. West, Mumbai. Board of Financial Supervision, BFS, created in 1994 to supervise banks and financial companies. Improves auditing systems and strengthens internal controls. Tarapur Committee, formed under SS Tarapur, former Deputy Governor. Studied. Capital account convertibility, allowing free movement of money between India and other countries for investment. Customer Service Department, CSD, created in 2006 to improve banking services and handle customer complaints. RBI offices across India. Heavy checkmark 4 regional offices, 15 branches, 5 sub-offices, 22 branch offices in major cities. Training institutions. Heavy checkmark Reserve Bank Staff College, Chennai. Heavy checkmark College of Agricultural Banking, Pune. Heavy checkmark 4 zonal training centers, Belapur, Chennai, Kolkata, New Delhi. Functions of RBI. RBI makes monetary policies to maintain price stability, economic growth, and financial stability. Repo rate at which RBI lends to commercial banks. Higher repo equals fewer loans, lower repo equals more loans. Reverse repo rate at which RBI borrows from banks. Banks deposit extra money with RBI and earn interest. Cash reserve ratio, CRR, percent of deposits banks must keep with RBI as cash. Higher CRR equals less lending, lower CRR equals more lending. Statutory liquidity ratio, SLR, percent of deposits banks must keep in liquid assets like cash, gold, or government securities. Controls financial stability. Open market operations, OMO, RBI buys/sells government securities. Buying equals more money in economy, selling equals less money in economy. 2. Issuer of currency. RBI is the only authority to issue currency notes in India. Coins are issued by the Government of India. Heavy checkmark prints notes under RBI Act, 1934. Heavy checkmark removes damaged/fake notes and replaces with new ones. Heavy checkmark adds security features, watermarks, security threads, color-changing ink to prevent fake currency. Heavy checkmark manages currency chests, storage, and distribution to banks. 3. Banker to the government. RBI manages the accounts and financial transactions of central and state governments. Heavy checkmark custodian of government funds. Heavy checkmark manages public debt, issues government bonds and securities. Heavy checkmark gives short-term loans to government, called ways, and means advances, WMA. Heavy checkmark advises government on financial and economic matters. 4. Regulation and supervision of banks. Heavy checkmark licensing gives permission to banks to start operations. Heavy checkmark prudential regulations, rules to manage risk and maintain financial stability. Heavy checkmark inspections and audits, regularly checks financial records of banks. Heavy checkmark consumer protection, banking ombudsman scheme resolves customer complaints. Heavy checkmark fraud prevention, monitors and improves cybersecurity in banks. 5. Custodian of Foreign Exchange. Governed by Foreign Exchange Management Act, FEMA, 1999. Heavy checkmark manages reserves, foreign currencies, gold, and special drawing rights, SDRs. Heavy checkmark controls sudden changes in the value of the rupee. Heavy checkmark ensures businesses can get foreign currency for international trade. Heavy checkmark supervises authorized dealers, banks handling foreign currency transactions. 6. Developmental role. Heavy checkmark promotes financial inclusion, banking for rural and poor populations. Heavy checkmark supports agriculture, MSMEs, small businesses, through refinancing facilities. Heavy checkmark encourages digital banking, fintech, and financial literacy. 7. Consumer protection. Heavy checkmark banking ombudsman scheme resolves customer complaints against banks. Heavy checkmark requires banks to be transparent about interest rates and charges. Heavy checkmark spreads awareness about online fraud like phishing and cyber scams. 8. Payment and settlement systems. Heavy checkmark regulates NEFT, ART/GS, IMPS, electronic money transfer systems. Heavy checkmark promotes UPI and mobile wallets for digital payments. Heavy checkmark expands payment infrastructure, ATMs, POS machines, digital networks. Role of RBI. 1. Issuer of currency, only authority to issue currency notes. Controls money supply to manage inflation and maintain economic stability. 2. Government banker, maintains government accounts and handles all government receipts and payments, taxes, salaries, welfare programs, and development projects. 3. Bankers bank, acts as the bank for other banks. Commercial banks keep cash reserves with RBI. RBI helps in clearing and settlement of transactions between banks. 4. Supervising authority, supervises the entire banking system to ensure banks operate safely and efficiently. Supports trade, commerce, industry, and agriculture. 5. Exchange Control Authority, manages India's foreign exchange reserves. Regulates the flow of foreign currency in and out of India and maintains stability in the value of the rupee. 6. Promoter of the financial system, acts as advisor to the government on financial matters, economic planning, resource mobilization, banking policies, and agricultural finance. 7. Regulator of money and credit, controls money supply and credit in the economy to achieve heavy checkmark price stability, stable prices. Heavy checkmark economic growth. Heavy checkmark full employment. Heavy checkmark balance of payment stability, record of all economic transactions with other countries. In short, RBI is the backbone of India's financial system. It controls money, regulates banks, manages government finances, and keeps the economy stable. Monetary policy of RBI, meaning and objectives. Monetary policy refers to the policy used by RBI to control money supply and credit in the economy. The RBI Act, 1934 gives RBI the authority to regulate currency and credit. The main aim is to maintain monetary stability and support economic growth. Objectives of monetary policy. Heavy checkmark maintaining price stability. Heavy checkmark ensuring adequate flow of credit to productive sectors like agriculture, manufacturing, and industry. Heavy checkmark supporting economic growth. Heavy checkmark maintaining financial stability, especially important as India is now more connected with global markets. Policy announcements are made 4 times a year. April, annual. July, Q1 review. October, Q2 review. January, Q3 review. 2 parts of policy statements. Part A, monetary policy, focuses on money supply, interest rates, and inflation control. Part B, developmental and regulatory policies, focuses on banking reforms and financial system development. Who does RBI consult? RBI does not make policy decisions alone. It consults stakeholders like banks, market participants, industry representatives, and trade associations. Technical Advisory Committee (TIC), a committee that studies economic conditions and monetary developments, then advises RBI on the direction of monetary policy. Key activities of the Monetary Policy Department. Heavy checkmark preparing the annual monetary policy statement. Heavy checkmark conducting quarterly reviews. Heavy checkmark organizing TC meetings. Heavy checkmark holding consultations with banks and financial experts. Important exam points. Heavy checkmark RBI was established on April 1, 1935, not 1934. The act was passed in 1934, but RBI started on April 1, 1935. Heavy checkmark SEBI was non-statutory in 1988, autonomous in 1992. Many students confuse the 2 years. 1988 equals created. 1992 equals given legal powers. Heavy checkmark coins are not issued by RBI. Coins are issued by the Government of India. Only currency notes are issued by RBI. Heavy checkmark CRR versus SLR. CRR equals kept as cash with RBI. SLR equals kept as liquid assets, cash, gold, or government securities, by the bank itself. Heavy checkmark PFARD-A established in 2003 pension regulator, not to be confused with IRDI, insurance, or SEBI, capital markets. Heavy checkmark IRDI headquarters equals Hyderabad, RBI and SEBI are in Mumbai. IRDI is in Hyderabad. FMC was also in Mumbai. Quick recap, all 5 regulators. Thank you for watching. Skill development questions for this chapter will be covered in Chapter 5 of IFS subject. Make sure to share with your friends and subscribe for more BBA, BCM subject, related notes according to